With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research with my guest today, best-selling author Nomi Prince, who is back with her latest book, Permanent Distortion. We're going to learn about that and so much more. First and foremost, Nomi, so nice to see you. I know you basically were in New York in and out. Sad I missed you, but congrats on your new book.
Oh, thank you so much. And I hope we don't miss each other next time I fly by New York. It's always great to be there and to talk to you.
Well, I'm excited to talk about your new book, which basically, takes a deep dive on how the financial markets abandoned the real economy forever. I can't think of a better time to be reading this book. And I've always said that your work and Jim Rickards' book should be required reading in all classrooms. But I think it fits in perfectly with the narrative that we're seeing with the Fed. And want to bring up something that you said the last time we spoke. You said the Fed has a problem articulating how to step back a plan after kicking it into overdrive. Are we at that overdrive now? Because it's clear to me that this is not the last rate hike.
No, that's right. It's not. And this is kind of what the Fed does. It overdrives and has, as we've seen after the financial crisis, after the pandemic, this is what causes permanent distortion between the markets, like sucking in that money versus the real economy that doesn't sort of get the same permeation of money. And they did that on the way down with rates, and the way they massively expanded their book with quantitative easing in these two major double doses during those periods, to the point where they have a $9 trillion book at its high. It's just a little bit lower than that. So their book is still sitting around $8.5 trillion, which is massive, which is historical, which is a lot of cushion for basically the markets, and particularly Wall Street banks, who are now about to buy back a ton of their stock, even though they stopped last year. Now, on the flip side, yes, the Fed also had a very aggressive rate hike policy over last year. It spooked the markets. It spooked the economy, and there's still going to be an overhang in the economy, even as the markets are going to get comfortable with the fact that the Fed has basically dialed down the size of its rate hikes. We've gone from 75 towards later last year to just 50 basis point hike in December to 25 basis point hike to open up this year. So they're basically going to dribble that down. They're going to go to neutrality. And then after that, I think they're going to turn around, check out the economy, see that the overhang, which Powell spoke about last week, is actually still in the economy, will increase in the economy. And at some point, they're going to turn around. And if they don't cut rates immediately, they're going to start to buy bonds again, or they're definitely, as we've already seen, going to back up from their plan to do quantitative tightening.
I thought so too. And I thought it was interesting. I had Kevin O'Leary on recently, and we spoke to Fed also, and he thinks this is going to be the last hike, and then they'll pause for a bit. Jim Rickards thinks there'll be two more, and then a pause in May. But, I went back and listened to the speech from Powell, and I thought it was pretty clear, and they're being pretty transparent, saying that they're not happy with what they're seeing in inflation. The job market's still too tight. And they're not going to stop just yet. And they were clear, saying you're not going to get a cut this year.
Yeah, and I absolutely agree that we're not necessarily going to get a cut in rates this year. And if we do, it's going to be December. It's more likely going to be early 2024. But that's why I do think we're going to see either a major backup from their original intentions of quantitative tightening or some sort of bond buying. I would not be surprised if, even though they're technically still in quantitative tightening mode throughout this later part of the year, they're still going to potentially buy some bonds here and there. It's going to be very interesting to see where we get on the size of their book. So they have this sort of background thing that they're doing with respect to putting money into the market in a different way. I think that we're going to see that pause. Probably by June, actually. And the reason for that is not because Powell's not happy, but because Powell has an ego. The data right now, as we've seen it from last week and in numbers going through the beginning of this year, already shows that something called the ECR, the Employment Cost Index, has come down from its increases last year to only increase by 1%. That is not keeping up with the current level of inflation at just over 6%. What that means is technically, if the Fed wanted to, it could look at the 1% and the 6%, wait till they kind of split the difference, get up to somewhere closer to 4% between those two, and then to 2% and call it a day. I think that's going to take a cycle or two of the FOMC meetings, therefore, to pause rates. But again, a lot of this is tied up in Powell's ego. A lot of it is that he had this posture of this heroic effort to stop inflation, even if it would hurt the economy, which it will, even if it's going to hurt real people, real workers, the real amount that they can buy with the wages that they actually earn versus prices that actually exist. So he still reiterated that at last week's meeting. So he's in this kind of shuffle. So I think we're going to get to neutrality more like June. But either way, we're going to see an ongoing back off of quantitative tightening and potentially more quantitative easing before we see rate cuts.
And I want to kind of use your Goldman Sachs experience here and all your financial literacy to help us with this, because I have a lot of experts coming on saying, they don't believe the CPI, that the Fed, when the government's cherry-picked numbers that are used to calculate CPI. Do you have any insights there? Like, what major data are they not using when calculating inflation?
Well, that's very true as well. And even to back up from that, the fact that the Fed even has positioned itself to be able to combat certain kinds of inflation, for example, like fuel and like food that are part of the contributing factors to the CPI, is a bit ingenuous, because they can't literally impact the cost of gas, for example. If we had another major shock, or an ongoing shock in Europe or between Russia and Ukraine in terms of supply, or something that happens with OPEC, with Saudi Arabia, with China and Saudi Arabia, whatever geopolitically, we could see fuel prices go up, and that's going to take CPI right up, and that's going to take fuel right up, and that's going to make the Fed look like they're not actually able to fight the inflation that they're talking about. So there's a sense of them not just cherry picking numbers, but actually indicating that they somehow have more of an impact than they do on inflation that impacts the pocketbooks of real people, like food, like fuel. The Fed can't do anything, for example, to impact the cost of eggs, the 60% cost of eggs, or basically any items that sort of go into, for example, any family's shopping cart. So there is on both sides a cherry picking of when they want to look at inflation. They didn't care about inflation when housing prices were going crazy, didn't even notice it, haven't noticed it since the financial crisis of 2008, not to mention the acceleration in the pandemic periods, even though we've come down a bit in prices. So yes, they do cherry pick. And that's why I think it's going to take a couple of meetings before Powell sort of is publicly satisfied, let's say, with what the Fed's been doing.
You made me think of a meme or post I saw on Instagram this morning that made me chuckle, that this Easter, we won't be painting Easter eggs. We're going to have to find a replacement for that. But I want to bring up, speaking of social media, one of your recent tweets where you say, yes, Fed logic. We're an estimated 102,000 Americans losing jobs at the start of the year. and in a single month is considered good news, but likely not good enough. That's more than twice the jobs lost in December and up 440% from January 2022. So just more to your point about the distorted reality the Fed lives with.
No, exactly, and the whole thing with jobs, which is really sad, is that because the Fed knows, for example, it can't impact the price of eggs or the price of fuel. These are things outside its purview. It's really honed in all throughout the rate hikes on the idea of the labor market being too hot and not acknowledging in this more recent period how the labor market is basically weakening, how we are seeing more layoffs and how we will see more layoffs. And either way, the wage increases have slowed down, and even those didn't keep up with the inflation of the cost of things that people actually need to buy for their homes. And so, yes,
Exactly.
all of this is a distorted reality. And I would imagine, I've probably written this or said this, that if Powell had to live on the average wage of an average American for an average week and buy the things that an average American needs to buy or use, he would not be able to do it.
Well, they're just so out of touch with reality. And wouldn't that be nice if they could just live a week in the everyday person's shoes?
Right.
I want to talk investment strategy with you now. Given the rising rates, is cash more attractive now than stocks and bonds?
I think it was in the more accelerated rise of rates, and it's certainly a place to be parked for people that want the sort of certainty of those higher rates. But I also think there are certain assets, and we've started to see them peak up. Gold, silver, copper, which is being squeezed right now because of mining capacity being taken offline in some places globally and not in other places. There's a lot of investments right now off the bat that are already and will continue to peak up because the Fed has basically entered what I've called stage one of its three-stage pivot. Stage one being they've reduced the size of rate hikes. Stage two will be rate neutrality. Stage three will be when they do start to cut rates, or if we see some QE in the interim. So in this stage one period, this is where other forms of hard assets that have both wealth preservation, some inflationary capacity in terms of combating where it is right now, and also use value in terms of where we need capacity to sort of meet supply. And so I do think there's a lot of, activity there. And I'm looking at that also in forms of energy, looking at, for example, further forms of energy like nuclear energy that have sort of come up in conversation more and more, which require uranium. So there are things right now, asset classes and sectors that really are good investments where the Fed is right now and going forward.
Well, if I can just get a few more thoughts on the commodities run, we're seeing obviously gold, silver. We see the appetite for gold, especially from central banks. We're seeing record buying. Turkey, largest buyer of gold last year. What is this indicating to you or saying to you? Is this a different gold bull run than others?
That's a really interesting question, and one of the things that we saw, and this kind of goes back to the financial crisis of 2008, which is that the world lost confidence in the United States banking system and in the aggressive easing policy at the time of the Federal Reserve. I mean, other countries had to kind of follow it, but certain other ones, like, for example, China, started to kind of have alliances with different other countries in the wake of not necessarily trusting U.S. monetary or banking policy. And this kind of has grown. Right. And in the period from 2008 through the pandemic to now, what's happened is major other central banks around the world that have their own alliances are looking at ways to diversify away from Fed policy, U.S. policy with respect to the dollar and so forth. And this run to gold in particular, this period right now, where, of course, at first after the pandemic, there was uncertainty. Gold held in very well relative to almost every other currency except for the dollar, because the dollar was on a tear up. And I think we've talked about that a little bit here. Right now, the dollar may still stay strong, but in this stage one of the Fed, in this current just demand and thirst for gold to be a diversifier in terms of real sort of traditional hard money away from the Fed and potentially potentially, I'm not saying we would go to a gold standard globally, but as a way to back and strengthen currencies outside of the sort of US dollar purview, is why these central banks have been so aggressive at basically buying and hoarding gold.
Well, we're seeing it with Iran, Russia. I mean, and we all know we don't know the real numbers out of China, but could that be it? Is that why China, we don't, like I said, we don't know the numbers, but we can all suspect that they were one of the major purchasers of gold. What are they looking to do with all of it?
Well, again, this is a sort of evolution from that real monetary distrust of the financial system and the Fed in the United States in 2008. And they have been sort of stockpiling since then, and they've more aggressively done so in this recent iteration because of two things. One, there was this other aggressive policy right in the wake of the pandemic in terms of easing. And then there is this aggressive policy of tightening for the various reasons that the Fed has talked about in terms of inflation fighting and so forth, and other nations have kind of had to jump in, which has increased the value of the dollar. So the way you fight all of that is in two ways. One is for China, for example, to buy more gold to potentially use as a backing for their own reserve, or for their own currency, basically for the yuan, and also create more and more alliances, which has been happening at the same time with Russia, with Saudi Arabia, and so forth, to introduce more of their currency into global exchanges. And so both of these things are happening at the same time, but it strengthens their hand to have something that could potentially, something real like gold, that could potentially be used to back their currency in some way as all of this continues to evolve.
I guess just final thoughts here, Nomi, bring it home for us. Like I said, you're out with your new book, Permanent Distortion. I urge everyone to get a copy. The main takeaway you want folks to go away with after reading the book, what would it be? What's the, I don't want you to give away anything, but what's the main message you really want to get across there?
Well, the main message is that the general fabrication of money and in how it's been done, and I talk about this in 4 different sections of the book, but how we've gone from a sort of panic, a frenzy, a chaos, ultimately to an overdrive and a metamorphosis in terms of how we all look at money and where it goes with respect to financial assets versus real assets in the real economy. And there's what I call a permanent distortion between those two things. And what we're seeing right now is a really interesting phase of that permanent distortion, which is with the Fed having gone so aggressive and other central banks following in the wake of the pandemic with easing policy, and then going so aggressive on the other side, we're now left with an environment where there are going to be very selective pockets of the real economy that are going to themselves start to sort of separate from the paper financial assets. That still means shares in companies that are related could rise, but in general are going to start to find some of their own ground, and also a lot of different alternatives to the current financial system, the current monetary system, are going to basically grow. We saw a stoppage in that last year with the uncertainty of the rate hike frenzy that the Fed was on, but now that that's kind of abated, I think we're going to see more of that come into play. It's going to be really interesting year.
Well said. Nomi, I wish you tons of success with the book. Thank you so much. It's always a pleasure speaking with you.
Thank you so much.
And thank you all for watching. We'll have more great content coming your way, so be sure to stay tuned to the Daniela Cambone Show here on Stansberry Research. And don't forget to sign up, danielacambone.com, so you can stay on top of all these great interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.